So you've got these two pools of capital, if you will, internationally. One is this serious long-term money which we desire, and one is this money which is coming through P-notes and the fast-moving money, if you will. How are they perceiving India today?
Right now, everyone has enough problems of their own. So if you're a pension in the US, and we all read about the pensions in the US, they've got payouts to make to their retired employees, to their ex-employees who are now retired. They were hoping that they'd be able to sell some of their assets at higher prices to pay off their outstandings. But there's a mismatch. Their asset prices have come down, stocks around the world have come down, their investments are losing money, and yet that payout hasn't changed. It's still what they got to owe people, once they retire, to pay their medical bills and everything else. So many pensions around the world are, in trouble in the near term. They have enough money to pay bills maybe for the next 6 years at this market condition, but not for the next 20 years. If you're retired, that's what you'd expect. So, but markets will bounce back. They were also in trouble post-tech bubble. They were also in trouble post-SARS. They were also in trouble in 1987-88. And each time the extent of the trouble varies. I don't have a sense of whether this is worse than what it was in 99 when the tech bubble deflated from 2000 2003. But I'm sure that markets will bounce back. I'm sure that equities will pick up, but there will be some bad decisions they have made, and they will take write-offs on that. So yes, there is long-term money. We should recognize that long-term money does have its own issues and problems today. But we should recognize that, and I want to clarify your question a bit, that India hasn't yet recognized, at least our policymakers in my view, have not yet recognized that we need long-term capital. They do not distinguish between long-term capital and short-term capital. And I scratch my head and bang my head in amazement saying, we're building a house in this country, you're building this long-term structure which is called the economy of India. Why would you want to borrow money from a local panwala, if you will, from the hedge fund guy who's taking money in and out every day, who's relying upon his daily inflows and outflows to give you money or take his money back, when there is a bank around the corner, institution around the corner, pension around the corner, which has got deposits and has got long-term objectives, you will need to go out and tap long-term capital. But I don't think our policymakers have yet come to grips with the fact that there is two kinds of capital, short-term and long-term, and policy making in India should be designed around what India needs, not around what Indian brokers need or Indian investment bankers need, but around what India needs. And that's the distinction that has not yet come through.
And how do you see flows from them over the next few years? Because ultimately, this is the pool of money which seems to determine the movement in the stock market.
Yeah. I think flows will pick up from that group. Like I said, they are going through some tough times of their own. But, we've been on the road for the last decade, if you will, and more so the last 5 years, trying to convince many of these pensions internationally that they should think of India as a geographical asset allocation, as a separate asset class called India, as opposed to emerging markets or BRIC or international or ex-US or whatever it is. And we won some, battles, but it's a long process. And I wish I could take finance ministers with me on roadshows. It'll make life for us and for India a lot easier. But so far we've done it on our own. So it will take time. It is happening. And in my view, it will happen even bigger in the next year or two. But it may not happen the next 2-3 months because of the way the world is.
Yeah. And that's the point I think we'd like to take up. You said that you see that money coming in 1 year, 2 years. November 2008, when we had you as a guest, you spoke about the index touching its all-time high again in 2 years. And since then, we've had this whole structure, if you will, fall apart even more. So what do you stand by that view, and what's your take now?
Yeah, I stand by the view that 18 to 24 months, that the markets will go back to a new peak. The markets will cross 25,000 index, in my view, fairly easily. I can't tell you what the index will look like because they keep on changing the index. Satyam was in the index. It's a disaster. They take it out of the index. Reliance is a big chunk of the index today. If it's there tomorrow, it may not. If it's not there tomorrow, they may take it out of the index or increase its weight if it's become a bigger company. So those things change. But I can tell you that in general, I believe businesses in India, the Indian economy will start doing, in our opinion, a lot better come June. So in the next few months, you'll start seeing better numbers. Again, this is with the assumption that there's no drought, there's no massive, problem on the rainfall side. But you will see a pickup in economic activity. You will see a pickup in businesses, and you will see a pickup in business profits, and hence in stock market levels. We believe that unlike a China, Malaysia, Thailand, Indonesia, which are export-led economies, where exports to the US primarily were the key driver, India was not and is not an export-led economy. We have no ports, no railway systems to move goods very quickly from place of production within India to point of consumption in the US, whereas China had, fabulous ports and power plants and everything to make sure that the goods reached the US and reached Walmart on time. But we do have a situation right now where the world is treating all emerging markets as one, and India, because of the fact that we took short-term capital flows, has been affected. But that distinction will come over the next couple of quarters as China slows down, as other economies slow down, and India maintains, in our view, a 6.5% GDP growth rate. Then that distinction will start being seen in stock markets. Right now, all stock markets around the world, as I showed in the previous slides, are being battered the same way. That distinction, in our view, will start in the next couple of months.